Coca-Cola İçecek is not a company that is going to be a quick double and then a 10x for your capital within a year. In fact, an investment like that probably won't be in equities. You may want to look at options or get some of that magic Nancy Pelosi uses. Now, as you may know, I am quite bearish on the indexes for the next decade ahead. I think that the current valuations are just simply too high. There is not enough underlying cash flows to justify the valuations for those names at the top. Sure, Meta, Google, Microsoft and Apple are somewhat more decently valued, but Nvidia represents over 7% of S&P 500 and over 9% of the QQQ index, and the company's market cap is around $4.5 trillion. I'm sorry, but it's just too hard for me to see Nvidia keep growing like they currently have and consistently bringing in over $500 billion every year just to justify such a market cap. And once they fail to be perfect, that creates a sell-off that will likely bring other names down as well. On the other hand, Google makes TPUs which rivals Nvidia, and other brands like Amazon are also making their own ASICs as well. Satya Nadella, which is the CEO of Microsoft, recently said that the bottleneck is not the GPUs, but it is the infrastructure that the GPUs will connect to. That is where the bottleneck is. In fact, let's listen to it directly from him. This clip is from Sam's podcast, BG2.
While we can't see out 5, 6, 7 years, certainly over the course of the next 2 to 3 years, for the reasons we just discussed, that it's almost a non-existent chance that you have excess compute.
Well, I mean, I think the cycles of demand and supply in this particular case, you can't really predict, right? I mean, even the point is, what's the secular trend? The secular trend is what Sam said, which is at the end of the day, because quite frankly, the biggest issue we are now having is not a compute glut, but it's a power. And it's sort of the ability to get the builds done fast enough close to power. So if you can't do that, you may actually have a bunch of chips sitting in inventory that I can't plug in. In fact, that is my problem today, right? It's not a supply issue of chips. It's actually the fact that I don't have warm shells to plug into. And so how some supply chain constraints emerge, tough to predict, because the demand is just going, is tough to predict, right? I mean,
so he says that the bottleneck is the infrastructure and not the chips themselves. That is not going to change overnight, especially in the US, where building infrastructure is a nightmare. That's why Google recently paid $4.75 billion in cash to acquire a company that has data centers and energy infrastructure. Not only is it too hard to find these assets, but it's also incredibly hard to build them due to regulations and bureaucracy, and that's what Michael Burry talked about in his recent tweet. And I quote, "Power needs keep climbing because efficiency gains cannot keep up with compute install. US transmission grid development is actually decelerating due to permitting issues, while China is building transmissions at will to match power output. The US needs to get away from bigger and bigger power-hungry chips and innovate with AI-tuned ASICs like nobody's business." And he's absolutely correct. If the US was building energy infrastructure as fast as China, then there could be a way to say that Nvidia's current trajectory is somewhat more sustainable. But it actually is not, especially if Nvidia keeps releasing new and much faster chips every 2 years. That is going to make the older ones somewhat obsolete. And I want to say that I am actually quite bullish on AI. I think it has tremendous potential, especially in cases like energy and innovation that can make solar panels and batteries much more efficient, or even cracking the code of fusion are all possibilities in the realms of AI. But I actually need to see it to believe it, because no matter the energy source, the grid needs tremendous investments to keep up. What is funding the growth currently is the Capex spending of the major companies, basically the 3 cloud players plus Meta. What you are betting on here is not only that these 4 companies are going to spend $100 billion on average per year per company, but also they are going to keep increasing this spending. And I am not even going to get in on the circular deals that they have. So in the end, it's a quite hard bet to make, in my opinion. I'm not saying that it is impossible. I'm just saying that it is too hard. Therefore, they go into the too hard pile for me. And as an individual investor with very limited capital, why would I need to own the index or these magnificent 7 names? As long as you are not managing tens or hundreds of millions of dollars, the investing world is just so much larger. You don't need to jump over the 10-foot pole of AI to get great returns. If you look around, there are 1-foot poles that are going to give you great returns as well. You don't have to make money from indexing or buying Tesla, Nvidia, or Palantir. The dollars are green no matter what company you are earning them from. So that brings me back to Coca-Cola İçecek. It is an old economy company. The business model is definitely not as good as the Coca-Cola company itself, where they mostly sell concentrates to bottlers and do advertising and have margins that rival the tech companies. Bottling is fundamentally inferior because it requires constant capex, but it still is a lucrative business. And CCI is also going to be the one that will directly benefit from rising beverage consumption in their operational geography. Speaking of that, non-alcoholic ready-to-drink consumption across CCI's countries is around 374 servings per capita. That is low. There is a lot of room to grow. The same figure is over 1500 in United States, and even in Chile is around 748, which is more than double of CCI's average. And even within CCI's own geography, the numbers are just crazy. Pakistan is barely over 100, and Bangladesh, which CCI acquired in 2024, is at only 48. And here is the part that makes Bangladesh incredibly interesting. Around 84% of total beverage consumption is tap water. It is literally an untapped market. Now, you might say, okay, Lunch, but what if those numbers don't grow? Do you really want to bet on Pakistan and Bangladesh? Well, no, not really. Because at today's valuation, CCI is definition of heads I win, tails I don't lose much. The EV to EBITDA ratio is about 6.4. And yes, depreciation and amortization are real expenses, I agree. But the EV to EBIT is also only slightly above 7. So even if I am wrong about the big penetration story in Pakistan and Bangladesh, the core business they already have is priced cheaply. And CCI is not like the average bottler either. Their EBIT margin is in the 16 to 17% range, while CCEP, the Coca-Cola bottler of Europe, sits a bit above 10%. That is a massive gap in favor of CCI. And one reason for that is their distribution model. About 80% of volumes are sold through distributors and only 20% is directly distributed by CCI, which is pretty unique among bottlers. So operationally, they are trying to run the playbook closer to Coca-Cola's own script. And the most important proof that this playbook works is Central Asia. Kazakhstan and Uzbekistan have been incredible. Before CCI acquired Uzbekistan in 2021, it had the lowest consumption in Central Asia. Today, it is approaching to almost Turkey's levels. Similar story in Kazakhstan. In the third quarter of 2025, the volume growth was 24% in Kazakhstan and 36% in Uzbekistan. So it's not hard to imagine a world where they repeat the same formula, especially in Bangladesh, where I personally think the runway is cleaner compared to Pakistan. Now, let me be fair and tell you what can go wrong, because this is not a perfect business. Number one, these are emerging markets, so there is macroeconomic risks that come with that. Number two, this is a bottler and not the Coca-Cola company itself. So for CCI, the Capex never goes away. Packaging, coolers, factories, trucks, it is always ongoing. So you are not buying a software margin structure. And number three, this is the key one, you are living inside the Coca-Cola system. Coca-Cola owns the brand, they own the concentrate economics, and bottlers do the heavy lifting. So there is a natural ceiling to how perfect bottling can be. But CCI, in my opinion, is very close to that limit. They have margins that are far above compared to the other bottlers. But here is why I still like it at this price. Most of the risks are already priced in the stock. It is what a 6 times EBITDA and 7 times EBIT multiple is basically saying. It is saying, we don't believe in this story. We don't trust these countries, we don't trust the currency, and we don't want capex heavy businesses. And that is exactly where opportunity can exist. Because the business itself is not broken. You have a distribution machine across multiple countries. You have a company that already proved it can take low consumption and expand them. And that brings me back to the point I started the video with. With the index today, you are basically underwriting a perfect future for the biggest companies. They need to keep spending, keep scaling compute, and somehow the infrastructure needs to catch up fast enough for the return on investment to justify the current numbers. With CCI, you don't need perfection. You need gradual consumption catch up over time, plus execution, plus evaluation that is already quite conservative. So no, CCI is not a quick double and then a 10x. It is not a lottery ticket. It is a rational investment in a boring business at a rational price, with a long runway in the countries that are open to growth. Also, almost all of the bottlers are valued with double-digit multiples, some even approaching 15. And I'm not even going to mention Varun Beverages, which is the Pepsi bottler of India, that is trading at 50 times EBITDA. CCI's growth prospects and higher margins are signs for me that there is a multiple appreciation waiting to happen as well. And in investing, boring can be beautiful. That is why Peter Lynch loved to invest in funeral homes while everyone was going crazy over the dot-com stocks. Because boring usually means the game is understandable. People drink these products in good times and bad. The company sells through a distribution machine that took decades to build. And across its geography, the runway is not about inventing something new. It is simply about penetration rising over time. And at today's valuation, I don't need a perfect feature to get paid. I don't need a great build-out, a new chip cycle, or constant $1 trillion capex to keep accelerating. I just need a steady execution and time. So the full CCI report is on my Patreon. One subscription unlocks everything. This report, all of my past research, every company I cover, including Raysash, it's all there. I highly recommend checking it out. You will be finding not only updates, but also deep dives on the opportunities that I see in the market. That's it for today's video. I hope you liked it, and if you did, please do YouTube links below, and I'll see you in the next one. Bye.